The market's starting the Santa Claus rally period with gains, and we're an hour away from the close on this holiday shortened trading day and stocks near the highs of the day. Our next guest here has a look at what will really matter to the markets in 2025, and they say it's all about inflation. Joining us now, we've got Alex Morris, FM Investments President and Chief Investment Officer. Alex, thanks so much for taking the time here with us today. So why is it all about inflation from your purview?
Well, I think it's all about inflation because everything we see in the market is telling us that. We see that in the long end of bonds pushing it that way. We see that from policy, right? No matter who you voted for, both candidates were running on very pro-inflationary policies. And it looks like we're definitely going to get that. And a lot of folks have been looking for inflation protection in sort of all the wrong places. Equities have done well, but that's been a mixed bag of some support. You were better off buying gold, given where the S&P and gold have done this year. But on the same token, commodities have really let folks down as an inflation hedge. So now folks are left wondering, where are they going to go? And we think that's much of what the conversation in the first quarter of the year is going to be about.
And what's your answer to that, Alex?
Although we say this at the risk of folks saying, hey, but they ripped my face off the last couple of years, we think a better way of managing tips is the answer. The government has a bond program that just puts it right in the name, Treasury Inflation-Protected Series. A lot of folks bought tips. They bought the mid or long curve. And when they did that, duration cannibalized all of their actual inflation protection. You're going to see us come out with some products in the first part of the year that are going to help investors really avoid the duration, but pick up all that CPI protection that tips offer.
That's particularly interesting. And so as you think about the protection that is necessary, how can investors really make sure that their portfolio does protect against any volatility that comes forward with future economic data prints that might continue to rattle what the markets have already been rattled by, which is a Fed that is putting out potentially less cuts than were expected next year?
So the simplest answer, we think, is T-bill and chill. We offer TBIL as an ETF. It's the short, super short end of the curve. It's the 3-month on the run, most liquid version of a cash bond that you're going to get. And we think folks have done pretty well there. You're still getting a 4.3% return. If rates stay where they are or just have 1 or 2 cuts, you're still going to likely see a 4 handle on that. That's a great place if you're uncertain. Let's not forget, 5 years ago, 4% was a dream in bonds. Now folks are complaining and lamenting it's not 5 like it used to be last year. But we think that's a great place to go. We're going to give some folks some opportunities next year to be in the shorter end of the tip space and a better way to manage that. That will be easier to access, easier to understand. But otherwise, we still think there's a real opportunity in shorter term investment grade bonds. Although you're going to see some rate movement that would impact principal, reality is coupons are pretty good. Most of the return you're getting in a product like Z2 or Z-Tray are giving you current income from mostly coupon, as opposed to bonds that are aged where you're just kind of hoping that price movement works in your favor. And we think investors are doing pretty well. You're going to earn 50 to 80 basis points over current treasuries for that. And you're going to be in the investment grade space where we haven't seen any issues, even threatening issues at all in delinquencies. So I think that's a great space to be. You can still clip a reasonable coupon and then some, and have a little bit of protection when rates come down. You're going to still get a little bit of an upside tick.